Nigeria's foreign exchange reserves are looking strong in August, adding about $1.46 billion month to date to $41 billion on the 19th of August. But for how long will this upsurge be sustained? Meanwhile, as the U.S. Federal Reserve faces growing pressures to slash interest rates, all eyes are on Jerome Powell's speech at the annual symposium in Jackson Hole. Dipo Ajayi, the head of fixed income and FX at Chapel Hill Denham Securities, joins me now for this conversation. Thank you so much for your time on the show today, Dipo. And let's get into what we're seeing play out with the FX reserves and what this milestone signals for investor confidence.
Yeah, thank you very much, Kenneth. Thanks for having me on today. When you look at currently what's happening with the reserve, I think it's not something unexpected. When you notice that the central bank has been a bit aggressive in their mop-up device, we've seen a couple of homo issuances in the months of July and August. And one of the things that will mean is that we'll see a lot of capital inflow actually coming in to the economy through that window. And aside that also, you will notice that the Nigeria capital market has been very, very aggressive. There's been a lot of activities happening in that segment of the market. So we've been seeing a lot of foreign investors actually coming to that market. And what that also means is a couple of inflows coming into that vehicle as well. And but the main aspect is the oil production. Kenneth, you understand that between the months of July and August, we'll see situations where Nigeria is currently now actually producing above the allocations by OPEC. And this is more like the best news that could have ever come to Nigeria. Because if you remember, during the last administration, there was at a time that we were barely producing about 900,000 barrels. Despite the fact that we have about 1.8 million barrel allocation. But currently, Nigeria is currently now producing about 1.8 million barrel. That is including the condensate. So this also means that it means that there are more FX revenue actually coming into Nigeria. And this looks more like a stable form of FX inflow than relying on hot money that will likely come from most of these foreign guys into our economy. And also another thing also is that we're seeing improved non-oil FX inflow as well because of some of the encouragement and policies by the government to actually encourage exportation of goods and services. So we've seen improved inflows in that segment of the market as well. And also we've seen reduction in form of importation. Most manufacturing companies are now looking at ways to actually look inward. If you understand what happened to the consumer names between the year 2023 and 2024. A lot of these companies suffered huge FX losses. So what they are currently doing is to find a way to actually source local raw material locally. And that actually reduced their dependence on FX, which could actually affect their business structure. When you sum all this together, you will notice that the handwriting was already on the wall. It's just that we are now seeing the full effects of this.
All right, let's come to the fixed income market, and I would love to get your expectations on the $200 billion bond auction next week.
Well, if you look at the last auction, the main instrument on auction actually closed around 1590 at the last auction, and also the 2029 closed second 1560. But tomorrow, but for next week, we think yield will actually climb and actually close above 17%, and that's close to about 200 basis points from where it actually closed at the last auction. Our view is premised on the revised calendar by the DMO. At the last auction, the DMO only offered around 80 billion at the last auction, but currently the DMO is currently offering about 200 billion on the two maturity. And what this will mean to the market is that it means that market will want to actually price the instrument higher, considering that there are more issuance than what was actually advised at the beginning of the quarter. So we'll likely see yield actually climb above 17%. We also saw that happen at the NTB auction on Wednesday, where the one-year paper actually cleared around 1744. That's about 94 basis points from where we actually closed fortnight ago. So if you look at all this together, and you will see that yield is actually inching up, and also the central bank also is actually setting this trajectory. when you see what has been happening in the HOMO issuances by the central bank, we keep seeing yield actually going north. And also, I think that the fiscal policy guys also are now trying to actually hold that line so as to continue to actually attract investors and also make a local investor comfortable.
All right, let's move on to the global front because we know that these global cues are quite important here, and all eyes are now on that speech by the Fed Chair Jerome Powell at Jackson Hole, and I'd love to get your take on what that would mean in terms of for the markets here for portfolio flows into Nigeria, especially when you look at what the FPI playbook has been so far this year.
Well, I don't think I expect anything extraordinary from that speech than for Powell to actually maintain his stance. The monetary policy guys need to ensure that they actually reinforce their independency in the market so that they will not lose the confidence of investors. And we've seen inflation continue to roar in the United States. The last inflation figure printed above expectations. And so it won't actually make any good sense for the Fed to actually cave in such a time like this. Assuming inflation has been static or we've seen a bit of disinflation, of course, there will be justification to actually want to do a bit of rate cuts. But when you look at what has been happening since the beginning of the year, since the Liberation Day, when the tariff war started, we know that this will continue to fuel inflationary pressure. And actually going now to actually cave in and turn from a bit of a modest, aggressive measure to more like a dovish measure, I don't think it will be very good for global economy. And but the flip side of it is that if the Fed actually ended up actually caving in, what it will mean to local investors, frontier and emerging markets, is that we will likely see more inflow of investments into emerging market, because what it means is that return will actually drop in developed economies. So you start seeing portfolio investors shopping and cherry picking instruments across the globe. And that will actually lure most of them to actually come to an economy like Nigeria, where they can actually get close to about 28% effective return on an automobile that is less than 1 year. And when you look at the carry trade opportunity there, that's close to about 25%. So I think it will actually mean good for the emerging market and frontier market if Powell ended up actually caving in such a time like that. But for me, I don't think he needs to do that. I think he needs to maintain his independence.
All right, then we'll definitely wait to see how things turn out. But thank you so much for your time. Dipo Ajayi, the head of fixed income and FX at Chapel Hill Denham Securities.